The UK economy is picking up pace as inflation and borrowing costs ease. With the new Labour government focused on growth, the output is improving, but capacity constraints could limit future expansion. In this market update, I'll explore the macro overview of market conditions. Marissa will cover construction output, materials and contractor capacity, while Ange will run through labour pressures and the impact of the UK's new government. Confidence in the UK economy is rising, with 2024 GDP growth now expected at 1 to 1.5%. Overall inflation rose to 2.2% in July, which was slightly below expectation as underlying pricing pressures eased. This was particularly evident in services inflation, which dropped more than anticipated. As forecast in our previous update, the Bank of England reduced the base rate by 0.25% in August, bringing it down to 5%. This provided some level of relief to the industry since this was the first time rates have reduced since 2020. Further rate cuts are forecast by the end of the year, albeit the cutting cycle is likely to be gradual. In July, the UK construction's PMI reached its highest level in more than 2 years, helped by improved confidence and the release of delayed projects. Meanwhile, in the job market, unemployment fell from 4.4% to 4.2%, but wage growth is likely to be further impacted by demand.
This year's construction output in most sectors is expected to decline. However, it is expected to grow by 2% in 2025 and 3.6% the following year. This is due to post-election stability, potential further interest cuts, and hopes for eased planning constraints. Material prices have declined by 2.2% over the past year, but have remained flat in recent months. That said, they are still 39.2% higher than pre-pandemic levels. With deflation pressures easing and higher demand expected in the market, we could see some supply issues, and therefore prices could rise. Contractor capacity is tight due to recent supply chain insolvencies. With fewer new orders, some contractors are eager to secure projects for next year's pipeline, but they remain cautious due to the current backdrop of failing businesses within the industry.
Construction vacancies remain above the 10-year average, but are close to normal levels as firms begin hiring again. June saw construction wages rise by 3.2%, which is up from May's 1.9%, although it's still behind where we'd expect broader economic growth to be. Therefore, labour remains the biggest cost driver and is likely to increase further as the market tightens. The new UK Labour government plans to boost construction by building 1.5 million homes. If this is achieved, it could increase pressure on supply chains, potentially leading to higher costs. The government also intends to update planning policies, streamline infrastructure projects, and really prioritise upskilling the workforce.
To summarise this quarter's key takeaways, on a positive note, interest rate cuts and hopes for further reduction could boost investment and revive stalled projects. However, as demand increases, there's a chance that prices for key materials could rise again. The impact of business failures on contractor capacity could reduce competition and slow down growth. And finally, plans by the new Labour government to increase the housing supply could put pressure on the supply chain and pricing levels. Our outlook has several positives, but we are keeping a close watch on the market's capacity and ability to respond to potential increases in demand.